I assume that I'm all set, right?
Good evening and welcome to our May Investor webinar brought to you by focusIR and London South East. For those of you who don't know me, I'm Donald Leggett. I'm your host for this evening. We're delighted to bring you some truly excellent companies tonight. Copper is at the heart of our event, touching as it does upon disruptive technology and M&A and a mega trend in its very own right. We have a London-listed North American mid-cap copper miner generating significant revenues, and yet with near-term growth potential, and an AIM-listed junior miner with similar potential. We also have two funds, with very different mandates, from global mining, shipping and energy to large cap technology and AI. There truly is something here tonight for everyone. If I could ask you to take part in a quick poll as we introduce the speakers. So if you can please tell us if you hold shares or invest in the listed companies and funds presenting. Our evening begins with the well-known WS Blue Whale Growth Fund manager, Stephen Yu, a fund launched by Stephen, and Hargreaves Lansdowne founder, Peter Hargreaves. Do you invest in Stephen's large cap global equity Blue Whale Fund? Please tell us yes or no. Next up is Ben Turney, CEO at Kavango Resources, the exciting gold and copper junior miner, exploring for copper and keen to quickly become a gold producer in Southern Africa. Do you hold shares in Kavango? Please tell us yes or no. Our third speaker is not to be missed. We have Stuart McDonald, CEO at Taseko Mines, who operate North America's fourth largest open pit copper mine, which delivered $525 million in revenue last year. Taseko are listed on London's main market, the TSX in Canada, and the New York Stock Exchange as well. Do you hold shares in Taseko Mines? Please tell us yes or no. Finally, we have Keith Watson and Robert Crawford, co-fund managers from the CQS Investment Trust. CQS are active investors in global energy and mining stocks, and they'll give us their very interesting critique on copper, on gold, on oil and gas, and all sorts of things. Do you invest in CQS Natural Resources Growth and Income Fund? Please tell us yes or no. Each presenter will speak to slides for up to 20 minutes before taking live questions from you for a further 10 minutes. And if you could start sending us your questions now, please, giving your full name and the name of the speaker or company it is intended for. If you can keep your questions short and to the point, we'd be very grateful. Some brief housekeeping points for you. focusIR is London South East's digital investor relations arm. We work closely with London South East, of course, and more recently, focusIR have begun to distribute content on the Research Tree and Armchair Trader websites, amongst others. As ever, many thanks to you all for joining us tonight, and it's time to hear from our four speakers. The WS Blue Whale Growth Fund is a concentrated, long-only global equity fund which typically holds between 25 and 35 stocks at any one time, with a focus on large-cap companies in developed markets. Returns over the last year are up almost 42%. Blue Whale was set up by lead fund manager Stephen Yu, our man here tonight, and backed by Chairman Peter Hargreaves. Here to discuss the portfolio and to give us his view of current investment trends, such as AI, is Stephen Yu. Welcome, Stephen.
Hi, good evening, everyone. Thank you for joining us. So today I would probably just want to run through the positioning of the portfolio, and I have got a slide for that to share. But if you haven't followed us, one thing that has been quite interesting throughout the course of the last 7 years when we started back in 2017 is the investment philosophy is very simple, that we aim to invest into high quality businesses at an attractive price. But what has been slightly different in terms of the position I'm going to take you through today is the opportunity set has evolved over the last 7 years. And of course, when we first started back then, it was pre-pandemic. We were heavily exposed to companies that are exposed to digital transformations. And digital transformation was a big theme at the time. And of course, then we ended up doing quite well during the pandemic in 2021 as well, 2020 and 2021 as well. And digital transformation at the time would encompass e-commerce, digital advertising, digital payments, software, cloud, and some others. And that's just like a very big theme in that period. But then in 2022, we recognized that we are in a new regime, which is a new regime that I'm going to take you through more in the next 10 minutes or so. And of course, then we have acknowledged that certain names that we used to own before is no longer the place to be. At the same time, we also ended up investing into some new names or positioning that we think is going to benefit under this new regime. Sorry, can you hear me? No. Okay. Would you be able to show the slide, page 2? Is it showing now? Okay. Thank you for that. So what you see on page 2, which is the how the fund is positioned today, I broke it down into 3 different buckets. One is what we call the transcendent companies, which would be companies that are exposed to artificial intelligence, and that would be kind of the similar way of investing into companies back before the pandemic that we think could transcend macro uncertainties. So these companies today would be names that are exposed to artificial intelligence, which I'll come back onto later. And of course, 7 years ago, it was a lot more to do with digital transformations, which I just mentioned earlier. But of course, just talk about in 2022, we recognize that we are in a new regime. What is this new regime? It's a combination of continuation of geopolitical uncertainties on the back of the Ukraine conflict, and we have seen a lot more over the last 18 months or so. At the same time, inflation to be quite sticky, and then at the same time, also the oil price, energy prices is going to remain quite high on the back of geopolitical uncertainties. And of course, when you put all these things together, what it means is interest rates going to stay higher for longer. And of course, a lot of people or investors are hoping that interest rates are going to get cut in the next year or so, which obviously I think where we are today, the interest rate is probably higher than what it needs to be given the level of inflation that we're experiencing. But what investor might be missing currently is the magnitude of the cuts or reduction that we will see in the coming years. So just a reference point, if you look at the US interest rate regime, the expected rate reduction, including that over the next 5 years, so between now and 2029, which is a long time from now, the average interest rate in the US expected is about 4%. So if you think about like in the next 5 years, the US interest rate is going to average at a rate of 4%. That's very high level compared to what we experienced before the pandemic, for the 10 years running in the pandemic. So then it does have implications in terms of what you want to invest into or companies or sectors that you want to avoid under this new regime. So what I've got in this second bucket, which we call them the new regime beneficiaries, are companies that would actually benefit from some of these uncertainties. And if you haven't followed the fund closely, in Q4 2022, we decided to invest into our first and only energy company, which is called Canadian Natural Resources. We do think oil price is going to be well supported at a higher level than before for the many years to come, just because of how OPEC is trying to kind of control, provide floor in terms of the oil price. And this company in itself, even though the sector, the energy sector to us is quite low quality, so hence we only have one company that is Canadian Natural Resources. And this company in particular, we would deem the company to be one of the highest quality company within the energy space, if not the highest quality, just because that it has one of the longest life reserve, which is about 40 years. And at the same time, a very low cost of production per barrel of oil, which is about $30. So then what it means is comparing to a traditional oil and gas company with a life reserve of about 10 years, a lot of the cash flow that they generate on the back of a high level of oil price would get returned back to shareholders through buybacks and dividends. And we have seen that the shares actually did very well in 2023 following our purchase. At the same time, even this year has done very well for us. So this is something quite new to us that we wouldn't have considered it 7 years ago. The other one, which if you have not followed it, is we also have a holding in Charles Schwab, that we would think the company would benefit with interest rates staying higher for longer. Last year, the company didn't do too well because of the regional banking crisis. We actually kept our conviction level. We have invested more when the share was getting hit in Q2 last year. And of course, if you follow the share price recently, that it started to recover quite strongly on the back of this thesis. So we would think that interest rates staying high for longer would be beneficial to the likes of Charles Schwab. And some names that might be apparent to you or not familiar to you in terms of the thesis would be MasterCard and Visa. I'm sure everyone would follow them. But then why would we be calling them the new regime beneficiaries rather than, let's say, maybe comparing to 7 years ago, we'll probably maybe group them under digital transformation in terms of the transition from cash to contactless to more payment in a digital world, which they make a lot of money at the same time travel as well. It's because that MasterCard and Visa, these two payment networks, they charge us a fee on our nominal spending, right? So if you go to a supermarket, let's say at the time inflation was at 10%, they basically charge a fee on that 10% inflation. If today in the UK the inflation is about 4 to 5%, then they would see that as a tailwind. So compare the inflation number, let's say the 10-year period running into the pandemic. I mean, the developed market was about probably between 1 to 2%. What we expect to come in the future, the inflation number is probably going to average between 3 to 4%. So what it means is MasterCard and Visa would naturally get a tailwind of a 3 to 4% growth in consumer spending, and at the same time, given the business in itself is very high margin, that they have a lot of operating leverage when they make more money on the back of just simple inflation numbers. So we actually like them. They have done very well last year for us, and so we continue to own these companies. And then within the artificial intelligence bucket, I don't know how much time I have. I'm happy to take some question on that. I think the one thing that you might want to remember, if there's one point I want you to remember, is GPU, which NVIDIA maintain a very large market share within the pie. GPU in itself, which is not what you find on your laptop or PC, that is a CPU. So GPU is the computing source of generative AI. So everything that you see today, whether it was ChatGPT, Midjourney, Perplexity, Google Bard or Google Gemini, what they call it now, Adobe Firefly, and any AI applications, that would require a lot of GPU computing power. Without GPU, if everything is being run on the CPU, that is no generative AI, because it might take them a couple of hours before they come back with a response, and no one is going to use it. So any investment that you're seeing or any company is coming out with an application, including even Microsoft launching Office 365 Copilot, they need to invest a lot of money into the GPU space. And of course, in today's context so far, NVIDIA maintain a very large market share, which we will expect that to continue in the near future. So the GPU market is exploding, and NVIDIA would continue to maintain a large market share. Maybe not as high as today, but still would be high enough to make a lot of money for shareholders. And our view is probably a matter of time before NVIDIA would become the biggest company in the world, surpassing both Apple and Microsoft, which is only a few $100 billion to go in terms of market cap. So that is why we still like NVIDIA, and we are still maintaining our very big position in NVIDIA, despite the fact that it's done very well for us. And then some other names, of course, they equally would benefit from generative AI, just not as much as NVIDIA. That's why NVIDIA is now the third biggest company in the world, would be the likes of Microsoft or Meta. Meta is a company that we really like. If you haven't followed the fund, we made a lot of money from Meta when we first started in the first few years of the fund. And in January 2022, we actually exited our holdings in Meta because we didn't like where the company was heading. Zuckerberg decided to change the name from Facebook to Meta in Q4 2021. And then there was some concerns about the TikTok competition and also the changes to iOS that in terms of the privacy settings, etc. So we actually exited the company in January 2022. But then when we came back, and then the share price actually went down a lot in 2022, if you follow the story. And then in 2023, when we started to do a lot more work on artificial intelligence on the back of NVIDIA, Microsoft, and some others, of course, Meta then came back to the radar. And then we did a lot of work on Meta at the time. And then we decided that Meta is actually going to get a lot of benefit from generative AI in terms of personalized advertisement, which we are going to get in time. So we initiated our position in Q4 last year in 2023, and then we ended up building a very large position quite quickly, just because we have followed the company quite closely before we started building the position last year. And so hence, I think over the last 6 months or so, despite the fact that, recently the share price have gone down probably 15 to 20%, but then we still have delivered a lot of performance on the back of that. We continue to like it. We have no concern about Zuckerberg spending more money. I think it's probably a bit more of a track record issue that investors are slightly concerned that whether Zuckerberg is going to do a repeat of the metaverse spending, which we are not a fan of, and we don't think he's doing that. But of course, I think there's some speculation that maybe people don't believe him enough. So for us, we have no concern of that. So we still think Meta is going to deliver this personalized advertisement to us with all the spending into the GPU market. And at the same time, I probably wouldn't have time to expand too much, but if you're interested, I'm happy to take that over the Q&A, is we also have some selective opportunities within the fund, such as the luxury brands in Moncler, biologics in Sartorius, and gaming or content in Nintendo, and then some others, so they don't feed into the typical bucket, which is artificial intelligence or the new regime beneficiaries. So the last point I will make on this is we are actually very cautious and concerned about the world, the outlook in terms of where the economy is heading. If interest rate continue to stay at a very high level, which is our base case scenario, if geopolitical uncertainty is going to remain, which we think this is the new regime, we're going to see a lot more of this. That is very difficult to find high quality businesses that can actually do well in this sort of environment. Because if you think about in a developed market, 2/3 of the GDP is linked to consumer spending in general, and of course there are many more companies to make money on the back of that consumer spending trend, whether it's discretionary spending or some others. That going forward, if interest rates are going to stay higher for longer, at the same time inflation can remain sticky, our discretionary disposable income, discretionary spending is going to remain under pressure. As time goes on, we will need to remortgage, more money is going to suck out from our wallet, and then we end up to be very selective of what else can we actually spend. How can we spend the kind of the leftover that we have after funding everything that's required. So the longer this drags on, is increasingly becoming a lot more difficult for companies which are consumer facing, whether you are technology power company or you are just a traditional consumer-facing businesses, and that is a big part of the market which we are avoiding at the moment. And then at the same time, going back to the composition of the fund on this slide, is while if you ask me, the one thing that I really want to invest into is artificial intelligence, but unfortunately, is in terms of opportunity set within artificial intelligence is very limited. So comparing the opportunity within artificial intelligence to digital transformations 7 years ago is a lot more, the winners takes all kind of mentality is a lot more limited. So there's only one NVIDIA and we have got enough, and then we are constrained that we cannot go above 10% and all that stuff. And so then within that bucket, it's only 1/4 of the fund that are exposed to artificial intelligence compared to to when we first launched the fund, digital transformation would probably accounted for maybe 50% of the fund, which then we ended up doing quite well. So it's just one of those things, like it's a new regime. A lot of companies that we used to like currently, like we have different concerns about where they're heading, so that we are not investing in the same type of company compared to before. And then we recognize that certain companies that we didn't need to invest into, and now would be the time to go into. So maybe I will stop here and see whether some questions.
Okay, Stephen, let me thank you very much. That is very interesting. You have your own unique perspective on the stock market, would you say?
I have a very unique view about the companies that we owned, and I think this is one of those interesting debates which we constantly get asked about from our investors. Is like, oh, are we bullish or bearish about the equity market? Like, should we like increase equity exposure through the S&P or maybe the UK stock market and all the stuff? I think currently, if you ask me, it does play into the strength of a bottom-up high conviction stock pickers, because we only need to pick about 30 companies globally, and I'm not forced to cover like 100 companies, because I probably would struggle to come up with 100 companies that can actually do what we just discussed. But if you ask me, oh, are we positive about the US stock market? I'm not entirely sure, because I think a lot of names, if you look at the S&P 500 index on an equal weighted basis rather than market cap weighted basis, that it has actually not done well, right? The market cap weighted index has done very well because of the big tech, because of some of the names that we just talked about. But a majority of companies under this new regime are facing a lot of headwinds. So I think the view that we took is a very unique view that we took is the companies that we have in the fund that we think they can continue to do well. But I probably are quite cautious about equity market in general, as in like any companies. I just don't think, unless interest rate does go back down to 2%, then of course you can make money from almost any equity within the market domain. But if that's not the case, it's just more headwind than tailwind for most companies, which is the stock market, isn't it?
But you've got almost 9%, 8.75% of your portfolio is held in NVIDIA, who make high quality processing chips. I mean, is there any degree of downside, any degree of risk in holding so much of your portfolio in NVIDIA, or are you completely sold on the fact that the AI trend, that it is the main beneficiary and it will become the world's largest company, as you foretold?
Yeah.
That was a brave call, by the way.
Yeah, so thank you for that. So firstly, this is a UCITS constraint strategy, so we cannot actually go above 10%. So 10% is the absolute limit. And if I just take you through very quickly about the journey, without going into too much details, was that we had about probably over 7% position in Q2 last year in 2023, before NVIDIA had the single day move of with the share price going up 25%. And of course, within a few weeks of that, in June last year, NVIDIA's market cap surpassed $1 trillion. Our view at the time was we had a lot more evidence or data about the applications of generative AI, which we didn't have when we started investing in NVIDIA back in 2021. So we actually like it more. And at the time, a lot of people were asking us, oh, many congratulations, you guys have done very well. NVIDIA's recovered very strongly as now a $1 trillion company. Are you going to take profit? And of course, with that rise in share price, the 25% increase, then it brought our position from over 7% to just short of 10%. And of course, I mean, now a lot of people would probably regret it, reducing the position in NVIDIA, which we did not. And then our response at the time was like, we just started a journey. So basically what happened was we managed to maintain our 10% position, very close to 10%, when NVIDIA, the journey between NVIDIA surpassing $1 trillion to over $2 trillion today. and had been a forced seller. So we have been forced to take profits because we can't go above 10%, and Nvidia just doubled in the last 9 months or so. But we still like it. What we are saying today is there's no doubt based on how we understood Nvidia, is it's going to become the biggest company in the world. It's a matter of time. Okay, is it going to happen in the second half of this year? It's unlikely. And then is it going to happen in the next couple of years? I think it's quite likely. But then the question is, let's say if I'm using Microsoft as a proxy, being the biggest company in the world in absolute dollars terms, that Nvidia only need to go up another 40% from here to become the biggest company. And if we can make 40 to 50% in 6 months or a year, okay, we definitely want to keep the position sizing that we have. But let's imagine that maybe it's not as smooth as it is. Maybe it would take 3 years for Nvidia to become the biggest company in the world. And then if we only going to make 50% in 3 years, which is about 15% a year, then we probably would have other opportunity that can deliver that sort of return, if not higher. So then the question from an investment manager perspective is like, we want to optimize the performance of the fund. Not that we have a different view about the prospect of Nvidia. It's just how much more money you can make from Nvidia after it's become the third biggest company in the world. So that is an internal debate that we're having almost every single day. I think I like it a lot, but ultimately, do you need to have a 9% position, or can you have a 5% position? I think it's probably with passage of time, we're probably going to have like a 5 to 6% position rather than a 9% position, because we would have other opportunities that we think that can deliver even better return for investors from here. Okay. So that is our take on Nvidia.
Okay, Stephen, let me ask you about semiconductor companies like Lam Research. You hold Lam Research at the moment. They tend to be quite cyclical. So, which doesn't sound like one of your high quality companies. Why hold them? Why hold Lam and other semiconductor companies?
Yes, no, thank you. This is a very important one. So I actually put them down under new regime beneficiaries in terms of, so the two holdings that we have on our top 10 are Lam Research and Applied Materials. So basically what happened, you're completely right. I think this is in the memory of many investors that traditionally the semiconductor equipment sector is very cyclical because the end market is consumers, right? The end market for semiconductors would be PCs, smartphone, autos, and some others. And I just talk about that. We are very concerned about consumer spending. Like how on earth would you want to invest into these companies that are exposed to the end market that we dislike about? Okay, something have changed, which is a very important one. So long time ago, that is all true. But since 2022, something have changed completely. What has changed is the geopolitical uncertainties. As we all know, currently Taiwan control over 90% of the high-end semiconductors production, right, through a company called TSMC. And as we all know, the geopolitical outlook or kind of the landscape in Asia Pacific is quite uncertain. I think a lot of people are concerned about it. Hopefully there's nothing going to happen, but that uncertainty would remain with us for many years to come. So what if one day that Taiwan is no longer autonomous region, or maybe falls under the control of China, then maybe become like a Russia, Europe situation that, oh, if you're friends, we're going to give you some semiconductors. If you're not friends, then you do not have any semiconductors. And at the same time, as we all know, Apple have all their chips made in Taiwan. Nvidia has all their GPU made in Taiwan. So our AMD CPU and all that stuff. So we would be in trouble if we do not have access to semiconductors. So technological advancement would just come to a halt. Like we just stop advancing. Like whatever the GPT-4 that we have, that is it. Like if we don't have the new GPU coming to us in the coming years, then there's no further development because we're constrained by the computing power of silicons. But of course, the Western government had recognized that. So basically, what happened in 2022, the US had the CHIPS Act of giving $50 billion of tax subsidies to incentivize companies to build new foundries in the US. And at the same time, in European Union, they also have a similar number, which is 50 billion euros of tax subsidies to incentivize companies to build foundries in Europe. So in total, there are over $100 billion worth of tax subsidies to incentivize new foundries to be built in the Western countries. And if you look at the numbers today, which is commitment in terms of the dollars terms, there are over 300 to 400 billion dollars worth of commitments to build new foundries in the US, many states in the US, in Germany, in France, and Intel just announced they're going to build a new foundry in Ireland, and then in Japan, in South Korea, anywhere outside of Taiwan, as far as the tax subsidy is concerned. So that if you're selling the mission critical equipments into the foundry, like applied material, Lam Research, we used to own ASML. We exited last year just on valuation ground, but the dynamics will be similar. Then they ended up selling many more the equipments into the new foundries with the government backing, with everyone trying to de-risk away from Taiwan. So basically what it means is the geopolitical uncertainty have given the semiconductor sector a very big tailwind, and this tailwind is going to outweigh the end market headwind in the next coming years, which is unusual. Like, we never had this before, because like if we haven't got these geopolitical uncertainties, then you want to avoid this sector at all costs. And I think if you look at the performance of this sector since last year, that it is now behaving not so much like the concern that we talk about consumer spending and all the stuff. It's about the new foundries being built and the certainty of how many more equipments they're going to sell into this new foundries. And that's probably going to get accelerated as well as the geopolitical uncertainty in Asia-Pac continues.
Stephen Yu, we're sadly run out of time. 30 minutes disappears very quickly when you're having fun. Stephen, you're a star. That was Stephen Yu. He is the lead fund manager at Blue Whale Growth Fund, and that was sparkling. What a great start to the evening. Thank you so much.
Thank you.
Our next guest this evening is Ben Turney, CEO at Kavango Resources, and a regular guest on our focusIR webinars. Kavango is a metals exploration and development company working in Southern Africa. Specifically, Kavango is developing gold, bulk mining opportunities in Bulawayo, Zimbabwe, and exploring large-scale copper finds in Botswana's Kalahari Copper Belt. Kavango has just raised a further $3.08 million in funding through an accelerated book build supported by major shareholder Pure Bond, as well as by non-executive director Peter Winter B and Ben himself. Welcome, Ben. It has been a busy time. When is it not a busy time for you? So why don't you bring us up to speed with progress?
Thanks for having me, Donald. Yes, it's been extremely busy. Is everything all set up correctly?
Yes, we're all good to go. I'm seeing your slides and I'm seeing you and I'm hearing you loud and clear. It's worth saying that you're live and direct from Bulawayo in Zimbabwe. Now, there's the first.
I am indeed. Let's hope the power holds up. We've had a bit of a dodgy day with it today, so the internet connection should be fine. It seems to be working at the moment. So here is our usual disclaimer. So today's presentation, I know that a number of our shareholders are watching, and I'm going to focus on the progress that we've made over the last 12 months since Pure Bond first put their major investment into the company, and what exactly our exploration targets are as we're moving forward. Our share price has performed extremely strongly over the last few months, and I think there are a lot of questions about where is the value now in Kavango. So what I'd like to do today is to present exactly what our plan is and hopefully just demonstrate exactly what our future might hold for us. Now, we've got one of the great strengths about Kavango is we have an extremely tight shareholder register. We've been very fortunate to recruit the Consagra family's private vehicle, Pure Bond. They took a 52% stake in our company last year, and as Donald kindly introduced at the start of this presentation, they've recently increased their overall holding now to just under 58% of the company, having underwritten our recent £3 million accelerated book build. Now, as promised last year when we did the deal, We said at the time there would be no further discounted placings and there would be no further warrant issues. So going forward, that is exactly what Kavango's financing strategy is. So we currently have about 1.5 billion shares in issue, which is a bit on the top heavy side. And the number of warrants we currently have outstanding are 280 million. Now, if those warrants do expire, we will simply let them lapse. That is part of our financing strategy as we move forward. One of the questions I often get asked, Donald, is well, what is your plan for delivering shareholder value? Will you pay a dividend, or exactly how will you distribute funds to shareholders? Well, we obviously need to have some tangible success, and I believe that we are on course to delivering that now. But ultimately, our plan will be, assuming we are able, our results in the field meet with our expectations, and we are able to deliver meaningful transformational amounts of money into our company, our plan will be to look to go through share buyback programs to tighten up our share capital as we transition from an exploration company to a mining vehicle. So the question then is, well, how are we going to deliver this ambitious vision of ours? In Botswana, we have just announced this morning, we've signed the drill contract with Mitchell Drilling for drilling our 5,000 meter diamond drill campaign into the Kalahari Copper Belt in the northwestern portion of Botswana. Now, over the last 18 months, we've done a huge amount of work on this ground. We've also consolidated our land package following the acquisition of the licenses from ENRG Elements last summer. Thanks to the Consagra's financial backing, we were able to conclude that transaction last year, and that gave us a contiguous land package between our Karakubis project in the west and our South Hansi project to the east. As you can now see, we've got the contiguous land package between the two areas, and this now covers what we believe are, or we hope, are two copper mineralizing systems. All of the work that our team has done over the last 18 months has been guided by Dave Catterall, who really is regarded as the Kalahari Copper Belt's leading exploration geologist. Dave was directly responsible for the discovery of Zone 5, the half dozen deep holes that were drilled into Zone 5 about 10 or so years ago, that led to the creation of that amazing mine and mining camp under Khoemacau Mining that's just recently been sold to a Chinese group, MMG, for $1.9 billion. Now, Dave is very excited about our ground because what he's seeing in terms of the mapping that we've done, the analysis that we've done on the ground, the physical data that we've gathered from drilling that was conducted by ENRG, from water boreholes that we've tested, combined with the various geophysics surveys that we've run and satellite imagery that we use, it looks like we have all the ingredients in place for a major discoveries in our Karakubis, what we're now calling our Karakubis block. And our ultimate target here is to find 100 million tons of copper, similar in style to the Sandfire deposits at A4 and T3, just slightly further to the northeast of our ground. We believe we're on the same structural corridor, and we believe we also have, as you can see on the two satellite images to the right of this slide, we believe we've got the same folding formations and structural traps that if copper mineralization did pass through our area in the superheated fluids, the right traps are in place for that copper mineralization to have gathered, we hope, in commercial sized deposits. Now, at the moment, the only thing that we still need to prove is whether copper actually has transited through our ground, and that's exactly what we're now coming up with our final drill targets, and we're looking to commence drilling at the start of June. This is the best work by a long way that Kavango has done in terms of our exploration. Under Dave's leadership, since he's become increasingly involved in the company, he's really transformed our efforts on the ground and upgraded significantly our capabilities. And we're very, very excited to commence this drill program in the next few weeks. Meanwhile, in Zimbabwe, we're now targeting what we believe could be a 10 million ounce gold camp opportunity. This might sound like an enormous target for a company like Kavango, but if you look at the potential, if you are ever able to come and visit our projects and see on the ground what we're actually doing here, the potential in Zimbabwe is just simply enormous. Zimbabwe has 22 Archean greenstone belts across the country. You can see them in green on this map. Now, what's fascinating about these Archean greenstone belts is that they are the same geological setting as the Archean greenstone belts that you see in Western Australia. These are some of the world's oldest rocks that are at surface, and as such, they're highly prospective attractive for metal deposits, in particular gold, because over the 2 to 2.5 billion years that they've been at or near surface, they've experienced a great deal of geological change and a lot of geological processes to transform the rocks, which significantly increases the chance of modern metal deposits. Now, the history of Zimbabwe and Australia almost mirrored each other in terms of development of their gold mining sectors from the late 1800s through to about the early 1980s. At that point, the two countries diverged as Australia went through the bulk mining boom, these open pit discoveries, looking at the historic high-grade mines and combining these into large-scale, lower-grade open pits. That process started to happen in Zimbabwe at around about the same time, but because of issues that the country faced as it was adjusting to life under majority rule and the tail end of the troubles that the country went through at the point of independence, that interrupted the development of this sector. But during all of that time, the geology has remained the same, and there were even some discoveries, a few open pits that were opened up, proving that Zimbabwe, in the same geological setting as you have in Western Australia, it has this potential for extremely large open pit mines. Now, what we're doing in Kavango is we're focusing on one of these 22 Archean greenstone belts. We've picked an underexplored, underinvested area that's quite quiet and quite out of the way. And this is where we have our Hillside and Nara projects. We've already drilled both of these projects. We've announced some very successful intercepts of both high grade and lower grade, quite wide widths, wide zones that we're looking at. And we're looking like we're building at Hillside, a 1.2 kilometers long that's open at strike, 600 meter wide target area that we're now going to go back and test with drilling. At our Nara project, we've just completed, or in the process of completing, our drill campaign there, and we're just sending off our first samples off for assay testing. We've seen some very interesting looking rocks from both visual inspection and XRF, and we're looking forward to the assay results. Now, what's been transformational for our company has been the involvement of Pure Bond. Since they invested £6 million into the business last May, this has really enabled us to take the handbrake off the company and push forward with the rationalisation of our project portfolio in Botswana, where we've now focused much more on the KCB, but also to recruit some top geological talent to help both lead and augment our exploration efforts on the ground. Dave Catterall, I've already introduced. His presence has been felt throughout the business, and you can see in terms of the overall quality and standard of the work that Kavango is now doing. Dave has really been sort of the key driver behind it. But alongside Dave, we also have Steve Smith. Steve is the former business development manager for Anglo American. He spent 8 years in that role in Tanzania. He's got 6 million ounces of commercial gold discoveries under his belt. He's been highly active in Zimbabwe since 2008, and Steve is the reason that we as a business entered into this jurisdiction last year. We've pursued Steve's vision for these large-scale open pit mining opportunities, and we believe that there isn't a person alive on this planet who knows as much about the Zimbabwe's greenstone belts as Steve does. The Consagras have agreed, and with the money that they put into the business, the £6 million last year, the £1.5 million they put in 2022, and the nearly £3 million that they've just invested in now, taking their total investment to just over £10 million. That's been meaningful for our company, and our team has really stepped up to this challenge. Where in the past we were much more focused on Botswana, our emphasis has now moved over to our projects in Zimbabwe as well, while still sort of keeping a focus on our efforts in Bots. So really, as a business, it's quite hard to describe just how much progress we've made. We've only been operational in Zimbabwe for 10 months. We entered the country last July. And as you can see on this really quite crowded slide, we have done an enormous amount in that time. We've declared our maiden resource. We now have a 6,000 ounce resource in the tailings dump at the Nara project. We've announced these fantastic results from the first two prospects, our first two holes, the highlights being 7.2 meters at 9.95 grams a ton. That's the one we're most excited about so far. But we also also hit some incredibly high grades at our prospect 4, 2.53 meters with over 2.53 meters at just over 29 grams a ton. These results really are fantastic, and with the follow-up work that we've done with IP surveys and the future drilling that we're now planning, we believe that we are on the cusp of making some bona fide discoveries, these open pit mineable opportunities. We've also done a huge amount in terms of establishing ourselves in Zimbabwe, from setting up the company, securing our ZEDA license, setting up our mining subsidiary. As a business in March, we entered into mining, and we've even started production. And across March and April, we've produced 2 kilos of gold already, and we've now upped our production target to 3 kilos a month by the end of this summer. So Kavango really has hit the ground running in Zimbabwe, and I'm really looking forward to where we'll be as a business in a year's time. I think by that point, we will hopefully have made at least 1, if not 2, major discoveries, and we'll be much closer towards mining those opportunities and bringing them into large-scale production. So the question then is, how are we actually going to achieve this? Well, we've raised now the additional £3 million following the results that we had at the Hillside project. The reason that we went ahead with this raise is we'd seen our share price gains over the preceding couple of months. We were very keen to protect that price and put in place a foundation from which the business could grow. We think that we are undervalued as a company, and we have a lot of ground still to go, but one of the difficulties of being successful in this game is it inevitably means that you need more money to be able to pursue your targets. Now that we've got what look like they could be the beginnings of commercial discoveries, we've got more work that we still need to do, but we took the opportunity to raise the additional funds so that we could accelerate our drill programs, primarily in Zimbabwe, where we're going to be bringing the drill rig back from our Nara project to our Hillside project, but also to ensure that we could pursue the Kalahari Copper Belt drilling without there being any need for delay. What we've done is we've now, with the extra funds in place, our original plan was we were going to use simply 1 rig. That would have been an 8-month program, which would have meant that results wouldn't have come out until Q1 next year. But thanks to the additional funds we've put in place, we're actually now going to be taking 2 rigs on, which means it will be a 4-month program, and we're expecting to have the full set of results this side of Christmas. So we've got a very exciting time lined up. We'll be making this presentation available online through our social media and on our website. There is quite a lot of detail to go through, and I think, Donald, you have some questions for me.
I do indeed, Ben. Thank you very much indeed. I think there's some overlap between what you've just told us and the questions that I'm just about to ask you. So we'll flex as we go through. But let me start with the obvious first question, Ben. Why did you feel it was necessary to raise that further $3 million in funding? You seem, by junior miner standards, relatively well capitalized, and yet you came back quickly into the market and raised another just over 3 million. Why so?
So we had, just before we did the financing, we had a balance of about 1.6 million. So we were, reasonable cash position for a business of our size. It was really down to a choice of we wanted to move our plans forward much quicker, Donald. So one of the problems that junior exploration companies can face, particularly around financing, is you can inevitably end up having to make compromise decisions as you're trying to leave yourself as much runway as you possibly could. Over the last year, since Pure Bond really threw their weight behind us, we've gained significant momentum in the field, which has been reflected by the fantastic results the team has been putting out over the last couple of months. So we were acutely aware that with the success we'd had at Hillside, we really did want to bring that drill rig back up to the Hillside project immediately and continue the drilling there. So the additional finance has meant that we've been able to bring that plan forward. But in the KCB, and perhaps we hope more importantly, our original plan, as I mentioned, was to have just 1 rig in the field. That would have been an 8-month program. With the month's delay that there would have been over the December Christmas holidays down in this part of the world, it would have meant we probably wouldn't have got our results until January or February, maybe next year. So we were very keen to see if we could bring a 2nd rig into the field so that we'd have the full set of results this side of Christmas. So it's all about gaining or building on the momentum that we'd already gained. And so far, I think the market's received it well. I think we're one of the few placings I can think of at the moment where our share price has actually gone up above the placing price. So I think so far it's proving to be the right decision.
Without a doubt, that's an unusual thing. Normally the markets follow the it depends on the valuation and the discount, and the market normally follows the discount down. So yes, you've done well. In terms of capital allocation, let me ask. Let me ask you. What are the competing needs and timeframes between Bulawayo, between Nara and Hillside, and the Kalahari? And what will you actually spend your new £3 million funding? What does that get spent on?
So our operational focus has certainly switched much more to Zimbabwe. We're building a great team here in Bulawayo. We've got a main logistical, commercial, operational hub, and we have our field team and our field camp are really in excellent shape. So the focus of the business has been much more on Zimbabwe. We have some news coming up of some further investments that we're going to make, and some other news as well, which I think will just sort of really underline our commitment to becoming a serious investor in Zimbabwe's nascent exploration space. We talked a lot about the first mover advantage that we have in this company and we're in this country, and we're very, very keen to do everything we can to seize that. In terms of capital allocation, I think we're probably looking roughly about a 60-40 split over the rest of this year. It's 60% in favour of Zimbabwe and about 40% in favour of Botswana. And the emphasis, of course, is because we have that second drill rig that we're going to be bringing into the field in Bots. So that sort of makes the ratio a little bit more even. But moving forward, we certainly see, depending on obviously what the results are, but our main operational focus is Zimbabwe. Of course, if we do strike copper in this drill campaign, which we are feeling very, very confident about, then of course at that point we will look at further drilling. So our plans in Botswana, we've still got a great team there. We've got the logistics hub that we've built and developed in Hansi, and our operational team and our operational focus, the guys that have been working with us now for a number of years, who are now being led by Dave Catterall. We're hoping obviously that they have the success that they deserve after all of their hard work, and will certainly continue to invest significantly in that project, subject to the results being positive.
Okay, Ben. Let me quickly talk to you about exploring and mining being such different businesses, requiring quite different business models. But I understand you've got lots of work in place, splitting Kavango into both an explorer and a miner. So why don't you tell investors about that?
So one of the key points of failure for any exploration company after they've made a discovery is making the transition into mining. We've seen recently a number of very high-profile failures on the market where companies have had what look like fantastic assets, but they haven't been able to bring them into production. They've typically failed either on not being able to raise sufficient finance or on not being able to become an effective mining company. In Zimbabwe, our strategy is to bring our projects into mining. So this open pit opportunity that we see here, there's no one else pursuing that at the moment. We've picked the greenstone belt that we really want to focus on, and we have this opportunity to build what we believe could be a 10 million ounce gold camp. That is a tier one asset, a genuine world-class opportunity. What we were very conscious of as a company is we didn't want to get to the point where we'd simply made the discoveries and drilled out the resources and had all the ounces without actually having any mining skills within our business. As you rightly said, the difference between a mining company and an exploration company is actually quite stark. They require very different teams, very different disciplines, very different processes. One of the great advantages of being in Zimbabwe is because there is this pedigree and tradition of smaller scale mining. It means that in parallel to our exploration team doing the great work that they're doing in the field, discovering what we hope will be these open pit deposits, we have an opportunity for developing Kavango mining, which at the moment is producing on quite a small scale, a kilo a month. It's around about $65,000 a month. So it's not bad, but equally it's not anything that anyone's going to get rich on. But our plan here is to build up the revenue so it becomes a meaningful contributor to our Zimbabwe operations. But more importantly than that, what Kavango mining gives us the chance to do is to put in place a strong foundation as a business so that once our exploration team has finished their work in the field and we've got what we believe are mineable deposits, we as a business should be able to make that transition from exploration into mining, we hope, quite seamlessly.
What kind of time frame would you be expecting that to take place over, Ben?
So the mining company is underway now. It started back in March, and we're looking to build that up to 3 kilos a month production by the end of this summer. Based on how long it will take to drill out the prospects that we have, we're very confident about Hillside based on the results we have so far, the fire assay results. We're very confident also about Nara. We've seen some really interesting looking rocks there, but we need to get the fire assays back. I think realistically, it will probably be the second half of 2025. I think it's at that point we'll be ready to start looking at some bulk mining. But one thing we are investigating on our prospect for the first set of results that we put out is we are considering a sort of small scale bulk mining opportunity. It's a bit of a contradiction in terms, but we think there might be an opportunity there, possibly to open up a cut and start feeding ore from that prospect down to our main processing plant. But that's something we're currently investigating. So I think a realistic time frame is second half of next year. But if there's anything we can do to bring those plans forward and make this all happen much quicker, this is an incredibly entrepreneurial environment that we're moving in, and it's living in, and it's possible to move very quickly. So if we can move quicker, we will.
Is it fair to say that you're simply looking to take any money-making opportunities and develop them?
Absolutely. One of the great weaknesses of the exploration space is that these companies are just enormous money pits, especially when you're listed as well, and all the overhead that you have with being a listed PLC. Not enough of these companies actually focus on building revenue and actually building profits as well. Those few companies that do focus on revenue, they like to talk about the revenue, but they don't like to talk about the profit because typically there isn't any. We want to become a profitable business in our own right as fast as we can.
But if you look at Caledonia mining, that's a useful example of a very profitable gold mine in Zimbabwe.
They've done brilliantly. Yeah, absolutely. If you look at when they first took that project on, the Blanket Mine back in 2008, they've had really amazing success there. They've had 10 years of consecutive quarterly dividend payments, which reflects the strength of their business. Like all miners, it's been a bit of a hard time over the last 18 months, but they really have done fantastically well, and it does show what is possible. Their mine is an underground mine, so it's different in terms of the model that they've pursued. We're looking for these near surface open pit operations. But what Caledonia has shown the way on is that it is possible to do business in Zimbabwe, and they built a company that's worth around about 150, 160 million pounds. It's our ambition with Kavango. We want to build a much bigger business than that. We think we have that opportunity in front of us, and let's hope we're right.
Okay, next steps at Nara and Hillside, Ben. What's going to happen in the short term? Would you be thinking of you've got 6,000 ounces of resource in a tailings dump? Would you be thinking of actually monetizing that?
As soon as we exercise the Nara option, we'll immediately move into monetizing that. We're currently working with a local metallurgist who's doing the met testing on the sands, just to make sure that we get the plant designed correct. We're looking at a CIL plant, a carbon in leach plant. We believe that would then be able to process ore from the surrounding area. The basic principle is that because the sands dump has ultimately come from the ore on that project, we believe that the CIL plant will be the right sort of design. We're looking at a plant capacity of around about 500 tonnes a day. So it will take about 4 months from commissioning the first civils. So that's laying down the concrete foundations and putting the civil engineering sort of in place, ready to put the plant on. It will take around about 4 months, we expect, to build the plant and bring it into production. It would then take just under 2 years. We're working on the basis of about 20 months at 500 tonnes a day to process those sands. But of course, if we're able to bring any higher grade ore into production, which we could crush and run through the plant, then obviously we would focus on that. So we would certainly immediately move into action on putting this plan into mining, on exercising the Nara option. But in terms of our plans from an exploration perspective, we are currently drilling our final hole at Nara, where we're testing the underground workings with quite a deep hole. We're drilling a 550 meter hole at the moment. That will be finished by the end of May. Our plan then is to take the drill rig straight back to Nara, where we've got what we think will be a dozen holes that we'd like to put into this hillside target. We currently have now what we believe is a 1,200 meter long by 600 meter wide target. We're not necessarily expecting that whole body will be mineralized in its own right. Of course, it would be fantastic if it is, but we think that might represent a couple of open pit opportunities for us. But we need to see what the drilling will tell us about the overall size and width of a potential ore body. So we're pushing ahead with drilling and hopefully defining what will become our first resource.
And those assays, they have to be sent out of Zimbabwe to be tested, is that right?
So the fire assays we're doing in Zimbabwe, we've put in place, it's not internationally accredited, but we've put in place quite extensive additional quality control. So the QA/QC that we're pursuing is much more rigorous than you'd have. We've basically doubled the standards that we've applied to this to help give us a degree of confidence. We're then sending the pulps from the fire assays out to the lab in Johannesburg for multi-element testing. So we're in the process now of shipping the first NARA samples to the lab in Zimbabwe to get the fire assay results. We're hoping to get those in about 2 or 3 weeks' time, those first sets of results. Then we'll be looking to apply to get an export permit to take those samples out of the country. In the meantime, we've just shipped our hillside samples out to Johannesburg, and we hope to have those results in about a month as well. So the process is a little bit cumbersome at the moment. I think that reflects that there hasn't been too much exploration activity in Zimbabwe. So there is a bit of the system sort of catching up with a company that's moving as quickly as Kavango is. But so far, we've had a very good welcome here. We're finding that all the various stakeholders and the ministries and everybody that we've engaged with, they're all sort of very open to trying to help us put in place the processes that will obviously work for us as a business, but will be able to work for other exploration companies as well.
Okay, my last question for you, Ben. Sadly, we're just about out of time. Let's turn to Dave Catterall and all those good things you were talking about in the Kalahari Copper Belt. You're just about to diamond drill 5,000 meters there. Talk us through in detail. You've got a minute and a half. What exactly is happening there?
Well, everything that Dave is seeing, and we'll have an update on targeting in the not too distant future, but all the feedback that I'm getting directly from Dave, I speak to him every couple of days, he's seeing the same patterns and he's interpreting the same results as we've seen further up the road at the Sandfire resources discoveries. We've got what look like the same structures. We're in the right structural setting. We've got what look like the right traps. We've got the right physical indicators of sphalerite and galena. Those indicate a copper mineralizing system. We've even got some slight traces of copper from some of these drill holes that were drilled to quite a shallow depth by ENRG. So we're feeling really confident about this ground. I mean, Dave is genuinely very excited about this. At some point, we'll be doing a public presentation from Dave where our shareholders in the market can hear from him directly about what it is that he's seeing. As soon as we've got those drill targets that are ready to go, we've got sort of the first batch as we put in the announcement today, so we are ready to start drilling immediately. But we're looking for the sort of the results of the work that Dave is currently completing, just to put together the full final suite. It's looking very exciting. It's greenfield exploration, so it's pure blue sky for a company like ours. But we have 7,500 square kilometers in the copper belt. It's the last large land package that is available. And if we look at the recent transaction, this MMG, that set a benchmark for potential valuations. So we're not expecting, obviously, a $1.8 billion valuation because we'd need to do a hell of a lot of drilling to get to that point. But even if we were to achieve 10% of that with the ground that we have, with how prospective it looks, and if we're even able to hit some commercial-looking intersections, then this will be a transformational event for our company, as we said in today's announcement.
Ben Turney, CEO at Kavango Resources. That's it for tonight. Thank you so much for joining us. That was really interesting, and thank you for giving us so much detail.
Thank you for having me.
It was a pleasure. As we said in the introduction, the next speaker is Stuart MacDonald, President and CEO of mid-cap copper producer Taseko Mines. It's not to be missed. Taseko currently operates Gibraltar, the fourth largest open-pit copper mine in North America, not to be sneezed at, generating significant revenues and developing a diverse pipeline of large-scale advanced stage mineral properties in North America. The Florence low-carbon copper mine in Arizona is expected to almost double copper production, and that comes next year, I believe. Taseko, ticker TKO, do remember that ticker, is listed on London's main market, TSX in Canada, and the New York Stock Exchange, with a market cap of around £590 million, with FY23 revenues coming in at around $520 million. So a pretty hefty mid-cap company. Welcome, Stuart. It's great to have you on this evening.
Yeah, thank you very much for having me on your program today. Great to have the opportunity to talk about our business and talk about copper, which is an exciting time in the market.
Stuart, the pleasure is all ours. Why don't you give us your presentation?
Great. Yeah, let me get into it here, and I guess the title of our presentation is describes what our company's up to. We're building in North America's low-cost multi-asset copper producer, and currently, right now, we've got the one operating mine, which you referred to a minute ago. It's our Gibraltar open pit copper mine located in central British Columbia in Western Canada. This has kind of been our foundational asset. We've been running it for about 20 years since we restarted it in 2004. And the mine's still got 21 years of reserves remaining, so lots of mine life ahead of it. And it's really been, as I said, a foundational asset, a stable cash flow producing asset that we've used to build out a portfolio of development projects. And I guess the next project, the project that we're most excited about, and it's going to become our second mine very shortly, is the Florence Copper Project. It's located in Arizona, just about halfway between Phoenix and Tucson. A great jurisdiction there, right in the copper belt. It's currently under construction, so it's fully permitted and financed. It's under construction right now, and first copper from that new mine is expected late next year. So it's a great platform, obviously focused in North America, very favorable mining jurisdictions. We've stayed away from some of the higher risk places around the world that have copper, but we like to operate here in North America. And I'm based actually in our corporate head office here in Vancouver on the west coast of Canada. Obviously, we really like the fundamentals of copper. We're happy to be a pure play copper miner with a growth profile, and we believe a proven team here of mine builders and operators. As I mentioned, we've been operating the Gibraltar mine now for 20 years. It's a very, I would say, our culture is, even at the executive level, is very engineering and production oriented, and we're taking that approach to the development of our second mine in Arizona. Commitment to strong environmental performance as well, obviously that's part of it, and social and community acceptance is a big part of our success in operating in the jurisdictions that we do. So a little bit about our capital structure. We currently have got a market cap of $1 billion Canadian dollars, about 750 US. We have had a very good run here in our stock price in the last 2 months or so, driven largely by the move in copper price, but also the progress that we've made at Florence recently, which I can talk about in a minute. We're listed on all three exchanges, London, Toronto, and New York. We've got broad analyst coverage across the three markets. Panmure Gordon and also Canaccord are our corporate brokers in the UK. But generally our shareholders are primarily North American, but we're making an effort and a push to broaden our base in the UK and Europe. And really, the copper story, I think today is getting a lot of traction, a lot of buzz. Really, I think the story of the supply demand fundamentals. I mean, it's really a long-term positive story, and it comes back to the energy transition. I think the shift that we're moving, that the world is moving away from fossil fuels towards electrification, and we can debate how quickly that's going to happen, but it is a trend, and that trend is very favorable for copper. Copper is the metal of electricity. It's required. It's ubiquitous across any energy. Any energy application requires copper, whether it's electric vehicles or renewable power generation. We've seen recent news about data centers that are a new and rapidly growing market for copper as well. All of these new technologies require copper, so the demand outlook is very positive. But equally important, I think, is we're a copper miner, and we see firsthand how difficult it is to bring on new supply, how difficult how much challenge the industry is having with bringing on new mines, and whether that's a focus on social issues, permitting risks, capital constraints, some of the activities of the mining majors. They're very much focused on M&A and dividends rather than actually building new mines. And this is a trend that we've seen for a number of years. And, the lead time that it takes to bring on a new copper mine, the analysts now can look ahead 5 years, 7 years with a fair amount of confidence and see that we have this challenge, this looming supply deficit. And this isn't going to be solved. We don't think that we see this, a very bullish outlook here out to the end of this decade with a supply deficit, and that means higher copper prices are needed to incentivize new supply, and that's what we're seeing now in the last few months here with the price move approaching $5 a pound now in the COMEX market today. I see. In fact, I think it went over $5 briefly earlier today. So it's very bullish backdrop. We are happy to have existing production. This is a picture of our open pit at our Gibraltar mine. It is one of the largest open pit mines in North America. And when you look at copper, we produce on average about 130 million pounds of copper from this operation. It's about 60,000 tons a year. Long mine life remaining, as I mentioned, and pretty exciting times for an operation like this with copper prices running as they are today. So we actually, a bit of history. This mine was actually built in the early 70s, and it was shut down for a number of years in the mid 90s. Taseko actually acquired it in 1999 for $1 in a period of very low copper prices. Restarted the mine in 2004, and that was very well timed with the copper price cycle, the last big copper price cycle between about 2006 and 2011. And we were able to generate good cash flow and reinvest that cash flow back into the mine. And we modernized the infrastructure. We actually built a second mill, and essentially ramped up our production, our milling capacity to 85,000 tons per day. And we've been running at essentially that rate for the last 10 years. And that gives us a very strong production base of 130 million pounds on average. We've been a little bit lower than that in the last couple of years, which I can talk about in a minute. But essentially, this is a pretty stable operation for us. We believe it's a well-run mine, relatively low cost and efficiently run. In fact, we've been a leader in health and safety performance, and it's a great opportunity for shareholders here. More recently, we've actually increased our ownership in the mine. Going back a couple of years, we owned 75% of this mine. A year ago, we bought out one of our shareholders to move up to 87.5% ownership. And then in March this year, we announced the buyout of our last JV partner, and now so that has stepped us up to 100% ownership. Those two partners are actually Japanese partners. They invested in the mine primarily to get access to our copper concentrate offtake. And there have been a number of changes in the smelter business, and those two groups, Dowa and Furukawa, they stepped away from the smelter business in Japan, no longer had need for that offtake. So it was a great opportunity for us as the operator of that mine to step in and step up to 100% ownership. We structured the deal on very attractive terms. Payments are spread out over 10 years in the case of the latest transaction. And it's a great, gives us immediate growth, gives us immediate cash flow and production growth with I guess that the longer term upside as well as we continue to see copper price growth. Here's the pit we're currently mining in, our Gibraltar pit. And you can see we're in the bottom of that pit. We've been there for the last 9 months or so with a good access to ore. We've had a number of good production quarters in a row. This year, production is going quite smoothly as well. We have signaled to the market that we'll have a little bit of mill downtime this year. We've got an in-pit crusher that's actually on top of our next mining area, which is the connector pit. So we'll have a little bit of mill downtime here later this month, but that's factored into our guidance. We're going to produce about 115 million pounds this year. And looking ahead to 2025, we'll probably see, with the mill maintenance behind us, we'll see our production step up again, back closer towards that 130 million life of mine average. And you can see in the chart there the leverage that we have to copper, right? Relative to our market cap, our company produces a lot of pounds. And every 10 cent or every 25 cent move in the copper price leads to significant incremental cash flow, about 45 million of additional cash flow per year. That leverage is why you see our copper price, our stock price moving in recent months with the copper price increases. So it's a good operation, stable, as I said. It's I would say Gibraltar is a lower grade mine probably when you benchmark it against global peers, but it's also very low cost when you look at how much it costs us to mill a ton of ore. We can mill about a ton of ore for about 13 Canadian dollars a ton. And that's very competitive when you benchmark it against any of the big copper mines in South America or Chile. They could be operating at 2 times that cost. So that's why we make it work, predict an efficient and productive workforce and a strong management team here allows us to make good money. Moving on to Florence, which is going to become our second operation here. This is the project in Arizona. We acquired it about 10 years ago. We are now in construction. This will add very meaningful production to our base at Gibraltar. We'll be producing, when we get to capacity here in 2027, we'll be producing about 85 million pounds a year, 40,000 tons, and also at a much lower unit cost of $1.11 a pound. So that's a very unique thing about this asset is the cost structure. 22-year mine life, again, that gives us a lot of runway here to participate in several copper price cycles ahead of us here. So it's in a great location, as I mentioned, just outside Phoenix, in a copper mining belt surrounded by mines and smelters. We've got all the major power, transportation, road and rail infrastructure in place. And we completed a test program, which I'll talk about in a minute, but it laid out I guess the economics of that were summarized in our feasibility study, which is about a year old now, but it identifies a 22-year mine life with annual production capacity of 40,000 tons, an after-tax net present value of approaching $1 billion and an IRR of close to 50%. And these were done at copper prices of $3.75 a pound, which is much lower than where we are today. So very unique asset. You don't see copper mines with these kind of capex numbers and cost, low operating costs. And the reason we do that, the reason we can achieve that comes back to the mining method. This is in situ copper recovery. And what we're doing here is injecting a diluted mining solution into the ore body. We have a highly fractured oxide copper body, which we can leach in situ. We recover copper in solution, and that solution is processed on surface. And we're actually able to produce refined copper right on site here. So you can see that our first copper cathode harvest out of our test facility in 2019. So yeah, it's very a very unique mining approach to the mining method. It's low energy consumption, low carbon emissions, and very low water use also when you benchmark it against other open pit mines in Arizona. So a number of those, I guess, ESG benefits that we have, in addition to, of course, being low cost. We don't have waste rock. We're not grinding and crushing ore. We don't have tailings or dust, or really, we have very little surface disturbance. So this approach and our mining method is been proven in our view through our phase 1 test work. We built and operated a production test facility in 2018. We operated it for about 18 months, produced over 1 million pounds of copper. We took all of that data from that test work, updated our feasibility study. It effectively validated our assumptions previously. We then moved into a new permitting process. As I mentioned, we fully permitted and we've got our final permits last fall in 2023, and we've now moved into construction. So we've got about $232 million to spend on construction. We've got to do 2 main things. We've got to drill and expand our test well field. So we had about 13 wells running in our production test facility. We will have about 90 wells when we move into day 1 of the commercial operation. And then, of course, we've got to build our plant on surface. So we've taken a lot of positive steps towards executing this program. We've signed a fixed price contractor with CQS, the general contractor. We've got all the long lead items on site, and we're well on our way to bringing this thing online late next year. First copper cathode expected in Q4. Funding is well in hand as well. As I mentioned, of the 232 capital requirement, we've got roughly $200 million of cash in our balance sheet now. That's pro forma for our recent financing activities that we completed in April. We've got a strategic partnership in place with Mitsui, Japanese trading company. That for us was a pretty important transaction to bring on a partner of that caliber that did a year of diligence on the technical aspects of our project and has stepped in. They're contributing $50 million towards the construction. They also have an option to invest an additional $50 million for a total of $100 million to give them a 10% JV interest. And that 10% interest for $100 million, really obviously implies $1 billion value here, which is close to the NPV in our view. So it's good validation. And Mitsui, we're happy to have them on board as a partner. So we also completed a royalty recently with Taurus, an Australian royalty fund. And we also have SocGen in here that provided a credit commitment in November. And Bank of America as well has provided some lease financing on our plant. So a very, very strong financing package with experienced mining investors stepping up and putting capital to work here. Here's some of the initial construction work. This is actually the first drill that came onto our commercial well field in February. We've now got 3 drills running with ramping up to 4 here very shortly. So it's a pretty exciting time for after so many years of permitting and financing activity to actually now be building the mine and looking ahead to bringing the mine on in a very positive environment for copper.
Okay, Stuart.
Quickly,
we're almost out of time here. If you could wrap up, I'd be very grateful.
Yeah, let me wrap up really quickly. I just want to. Obviously, the core focus here is Gibraltar and Florence. We do have 2 other projects back in BC, Yellowhead Copper and New Prosperity Copper and Gold. They're very large, undeveloped projects. And that gives us a very attractive copper reserve base, which which benchmarks very well against some of our peer companies. And our business, we're in the business of really developing those reserves, taking a prudent long-term approach and bringing reserves into production. And that's the approach we've taken at Gibraltar for the last 20 years. That's the approach we're now taking at Florence and realizing the value there. And of course, Yellowhead and New Prosperity are future opportunities. So, we've got the team to do it. We've got the balance sheet in place now, and now we just have to execute and realize our growth strategy. So, yeah, I'll wrap it up there and leave a bit of time for questions.
That's superb. Stuart, what a fantastic business you run there.
Sorry, what's that?
What a fantastic business you run there, Stuart.
Yeah, no, we do. I think it's pretty unique now in the market to have the existing production with the growth profile and focused in tier 1 jurisdictions, right? I mean, I can't think of any other copper producers that have this profile in front of them. So yeah.
You said at the end that you hope to get Florence online in production for our store, however you want to phrase it, at the end of next year. So that means you might almost double your copper production by the end of next year.
Yeah, well, we won't. We'll just start probably late next year. So 2026 will be kind of a ramp-up year. We'll produce probably about 50 or 60 million pounds in 2026 out of the new operation. And then by 2027, yeah, it'll be roughly 70% growth from where we sit today.
Okay, ramp up. That's a terrific phrase. Now, it just takes us naturally to what is usually my final question, but it really is. You've really just, over the space of 23 or 24 minutes, you've actually you framed the investment summary, really. Could you crunch that down and give me a shorter version of it as to why is now a good time for investors to put Taseko Mines on their watch list?
Yeah, it's really we've had some appreciation, obviously, in our share price the last couple months, but we don't believe we're getting the value in our stock now for the new Florence project. When you look at the true kind of DCF value of Gibraltar and Florence, see on the chart here, there's a big value gap, about 1 billion Canadian dollars, just between our current market capitalization and the true value of those two assets. That we believe mainly relates to the Florence project. And as we continue to move that asset towards commercial operations, we're going to see that value gap close. And that's truly the short-term opportunity here for shareholders. With those two assets running, Gibraltar and Florence, just on any reasonable ratio, we should have a much higher stock price than we do today. So yeah, it's pretty exciting.
So what might investors be looking for to de-risk Florence? What is it you think that they haven't quite bought into yet, but that they simply will, because when Florence comes online, it will start to deliver, as you say, ramp up, which is your great phrase.
Yeah, part of it for us is just getting our message out. We did have a number of years there where we were waiting for permits, essentially. And I think the market kind of got a little bit tired of waiting for permits. That's a common thing in our industry when we're developing new mines. It's a long process. I mean, we were at it for almost 10 years at Florence. So getting out now, telling the story and really showing people the opportunity that we have here to move to a multi-asset producer. I think with Florence too, it is a different mining method, and we do get questions about the in situ copper mining method. But our view of that is we've proven it. We operated the test facility. We didn't have any issues with producing high quality copper cathode, and yeah, we're very confident in our ability to ramp up a new mine. And I think when we do that, it's
Okay, we've got a question from Peter Higgins here. It's a long question, so let me paraphrase. The last sentence, he's talking about the copper deficit and electrification and all the other applications that could use copper. Could the mining industry face a copper deficit? Pardon me, towards the end of the decade? Do you see a copper deficit towards the end of the decade, Stuart?
Yeah, no, I think it's almost a consensus view now when you look at all of the analysts and pundits out there. Whether that's 5 million tons. Right now, it's roughly a 25 million ton market. Some analysts are talking about a 5 million ton deficit by the end of the decade, or higher numbers. The challenge is obviously bringing on new supply. It's just very difficult for the industry to bring on new mines. And even when you look at some of the majors, they're having challenges even maintaining their production at the current levels. So it's really a very positive story for producers like us that have growth.
And you've got a financial JV going with Mitsui. Now, do they have an offtake on some of that Florence production that which is to come?
They do, yeah. So that was their strategic rationale for making that investment, was to get access to Florence's copper offtake. They're going to have 81% of the offtake for the first 3 years of the mine, and we're hoping, working with them, to develop a market for low carbon copper. I think the mining method at Florence allows us to potentially brand the product in that way, and we expect the offtake will stay in the U.S. market and feed into the supply chain for electric vehicles and renewable energy uses.
Talk us through low carbon copper a little bit. Does such a thing exist in the marketplace today? And will you be filling a need, a demand, from the green copper use, if you like?
Yeah, it's an interesting question. I mean, it's something we get asked about a lot, and I guess we'll see how the market develops for some of these metals. Ultimately, I think it's going to come down to consumers. Are you willing to pay a little bit more for your appliance, or for your auto manufacturer, or for your car, your electric vehicle, knowing that potentially it's got low carbon sourced materials in it? If people are willing to do that, then projects like Florence are going to be able to sell their copper at a premium.
Now, I'm going to ask you a very personal question. Mitsui, did they want to buy copper, or did they want to buy low carbon copper? Was it did it influence their JV with you?
Yeah, no, they want to brand this project as a low carbon producer and develop a market for that product in the US. And ideally, we're all able to sell our product at a premium, right? So
fantastic, sure. So you've proved that it works.
Yeah, no, it's been a good story, and we just have to keep it going here and really execute on the construction and the ramp up.
Stuart McDonald, thank you so much for joining us today. I understand that you've got Scottish antecedents in Canada, so I'm delighted to hear that, and delighted to hear that the Scots are still continuing to do well in Canada.
Great. Okay. Thanks very much for having me on the program.
It was a great pleasure. Stuart McDonald, President and CEO of Taseko Mines. Thank you so much for joining us tonight. And finally, we're joined tonight by Keith Watson and Robert Crayford, co-fund managers at CQS Natural Resources Growth and Income, ticker CYN. The CQS Investment Trust holds an active portfolio of global mining and energy equities in a closed-end trust. The fund is trading at a 52-week high of 194 pence per share. With apologies, that's yesterday's price. I haven't had a chance to check it today. And has returned more than 150% over 5 years and up almost 28% since the end of February, which is pretty scorching. So well done indeed to the team. Indeed, in 2022, CQS won the Investment Week Natural Resources and Commodities Trust of the Year. No mean feat. Welcome to Robert Crayford and Keith Watson.
Well, hi, thank you. Thank you for having us on today, and thank you for everyone that sort of stayed so late in the evening. I appreciate it. It's getting a bit late. We're into the graveyard slot, but hopefully we can tell you a very interesting story and keep everyone wide awake. But yeah, so we're here today to talk about CQS, Natural Resources Growth and Income, and I'm under strict rules on time, so sorry if I fly through this a little bit too quickly for some. But yeah, so the fund, it's about 148 million sterling investment trust. So that means closed-ended. That gives a bit more flexibility around liquidity. It's on a discount currently of about 13%. It pays a dividend of 3.2%. And yeah, so who's behind it? So yeah, CQS is a $16 billion asset manager, but just in the last few weeks, we've been taken over as our parent company. So the parent company is Manulife with about $1.5 trillion in assets. So whilst the funds themselves are huge, just short of 150 million, we do have a lot of backing and big corporate backing behind that gives us all the infrastructure, IT, etc., etc. So a quick one on who we are. So clearly Keith and I are on this call today. We're the co-managers on this fund. I'm a geologist by education. I've been focused on mining and energy stocks since 2004. Keith, I don't know if you want to do a quick intro.
I can do. I've been working in the fund management industry and the resources sector since '92 when I started with Scottish Amicable. Rob and I worked very well together. Rob being the geologist, I did more engineering and tend to focus on the processing side. That is actually quite useful in terms of looking at some of these companies. Thanks, Rob.
Yeah, so a little bit more on where we're positioned. So yeah, you can see here we do a quick breakdown of our current sector exposures. I think one of the key things just to make clear on this is the mandate is relatively fluid, so that gives us quite a bit of flexibility, so we can allocate towards those commodities and areas that we see the best opportunity. So that is both in the underlying commodity price, but also valuation. So we're very value focused and that's pretty key. And I think you'll see as we kind of break down through some of the sectors. We run 3 investment trusts, so this is one of them. We also run the Geiger Counter Fund, which is focused on uranium mining equities, and the Golden Prospect precious metal mining trust as well. So there's clear overlap here, and the best ideas from those are also reflected within this fund. So yeah, just talking on exposures. So we currently see some very attractive opportunities in precious metals. That's because we see upside to the commodity price, but the main reason is the stocks themselves have really lagged this move, and we think are attractively valued. Energy, we think there's a really strong fundamental story to that, ultimately down to constrained supply. Uranium, clearly one close to our hearts. We think that's got some fascinating or sort of some fantastic fundamentals sort of driving that going forward. And then we'll touch on shipping. While we have a relatively low weight to base metals, we can have exposure to things like coal as well as energy transition commodities like lithium. And we'll kind of break that down in a bit more detail. Performance-wise, so yeah, the fund's been a very strong performer. You can see here on an absolute basis and relative. Here we've got the performance or the fund itself, NAV in the dark line. Below that, we've got MSCI World Mining in blue and MSCI World Energy in the sort of slightly off-green color as well. We put in just some details here on the top 10, just to kind of give a bit of a flavour. We do describe the fund as being kind of small mid-cap. One thing we just want to clarify on that to UK investors, that isn't like AIM small cap. This is more on a global scale. So just in the top 10 here, you can see, we haven't included the market caps, but they're all above $1 billion in value, with the exception of Karora, which is there at number 10 at sort of $0.95 billion. Within that, there's some larger names. EOG is at 75 billion market cap, and we've got the likes of Diamondback at around 45 billion as well. So so with top 10, fairly concentrated at around 40% of the portfolio. The top 20 constitutes 62% of the portfolio, so you can see a fairly high focus, concentrated portfolio in that. Below those names, we do have some smaller exposures as well. That's in some of the smaller market cap type names where you have more of a heightened kind of risk reward type profile. We think it's better to be a bit more diverse, and the positions aren't as concentrated below that. But within that, you can kind of see that focus I was talking to earlier. Heavy presence there from oil and gas, precious metals. And the largest position being NextGen, which is a uranium developer. Other than that, the rest of them are all producers, all free cash flowing. NextGen is just a truly well quality asset. Just on some key themes through the portfolio. So energy remains a real focus. We can see on this chart on the right. This is one of the key charts we think to kind of explaining. We hear about energy transition and renewables. I think it's important just to flag here that renewables still only constitute around 7% of global energy supply, and the requirement for fossil fuels is likely to remain. That big black slug in the middle is coal. Ultimately, that will be phased out, but probably to the benefit of gas. And oil, even with EVs, oil's still going to have a very relevant presence going forward. We would, the fund itself is about 51% exposed to energy, and that includes oil and gas at 25%. But we would also, within that, include uranium, which is the only source of zero carbon baseload power, ultimately essential to any emission targets set at COP meetings. But equally shipping, transporting, our exposure here is through crude shipping and LPG shipping primarily. And coal ultimately will retain a place, probably certainly more driven by emerging markets than in the West. But valuations are set by the West, and as a result, we think the perception of the valuation of those companies is overly bearish relative to the actual underlying fundamentals. Chart on the top right, I'll just reiterate here. This is EIA data, so US Energy Agency. They're just highlighting here how oil demand will continue to grow over the next few years, albeit at a slightly slower rate to what we saw in 22, as we're kind of coming out of COVID lockdowns. And as you can see through those red sections of the bar, that's primarily driven by China and India, and across non-OECD countries. So it just shows emerging markets remain a primary driver here. They can't afford EVs in the same way. Hybrids are going to remain a very important part of that segment. Yet at the same time, we're seeing supply being heavily constrained, given ESG requirements and focus on corporates who are now targeting dividends and buybacks rather than investing on new supply. So ultimately, that leads to a constrained market, and we believe positive risk rewards going forward because the equities are discounted and the underlying commodities should remain supported by constrained supply. Precious metals, conscious of time, it is a key theme in the portfolio. So we have gold just around all-time highs, but we still see reasons for that to potentially go higher. Primary reasons here being strong central bank demand, as highlighted by that bar chart on the right, which have been steady buyers for 10 years. So bipolarization of global geopolitics should continue to see central bank demand remaining very strong. And what we have seen more recently is demand in Asia has been the primary driver of this all-time highs that we're seeing. Yes, at the same time in the West, we've seen steady selling from ETFs and more broadly. So our view is if ETFs turn back to being buyers again, that could drive the gold price notably higher. But ultimately, our view here is even in a flat gold price, the stocks have really lagged this move. And we do anticipate a degree of re-rate as we move through the next couple of quarters. And that higher gold price starts to feed through into free cash flow, feeding through down to the bottom line. There have been some reasons that they've underperformed previously, and that had been cost inflation, which had ultimately squeezed margins. What we're now seeing from the corporates is that cost inflation headwind is now shifting to a tailwind as some of those cost pressures are starting to ease. But coming back to that main point, the stocks are at the lowest multiples that we've seen in history. And we believe that weak sentiment towards the sector or general lack of much interest is going to lead to a bit of a degree of covering, and people start to add back exposure. We still think gold adds an important defensive role to portfolios, particularly in an uncertain world that we see currently with geopolitics, whether it be ballooning government debt, US debt levels at 34.5 trillion, increasingly looking unsustainable in a higher rate environment, and add to that potential risk of stagflation as we're starting to see slowing GDP numbers and sticky inflation. I haven't got time to dwell on the names, so I'll move on and I'll pass that over to Pete.
Thanks very much, Rob. Yes, gold is a very cheap form of insurance in the portfolio. But moving on to uranium, I mean, this is something which we've been following for a considerable period of time. And I think the crucial point to note on this chart is that there has been, or there is now an outlook for a consistent and growing deficit in supply. The green line represents expected demand. The yellow line represents expected supply and includes, out to the end of this decade, production from both brownfield and some new greenfield projects. They're implicitly in there. More will be required. The key theme, though, is that following a decade of underinvestment and the recent energy crisis, that prompted a sea change in both government and public opinion towards the sector. It was a real reality check, and I think particularly with regards to the energy transition, which had to suffer a sort of pace change. It was no longer transition at any cost. It had to take place at a reasonably affordable cost. And the result of that is that there was a reassessment of the industry based on the reality of economics. Clearly, it's got the green credentials that Rob outlined as being the only zero carbon form of baseload. But as a result of all of that, we had very favourable policy and regulatory changes, which gave the utilities the ability and confidence to go out and recontract. Last year was the first in over a decade that they acquired as much material as they actually consume each year. And that is something in the context of the current geopolitical climate, which is arguably complicated by the US passing of its ban on importation of Russian material, only putting greater emphasis on the need to find new sources of pounds. And where are they coming from? That's the difficult bit. The market is very concentrated, and more diversification in order to secure supply is needed. We've outlined that NextGen is one of our key positions at $75 a pound. It's still trading at or about NAV, but this is a strategic asset with resource growth potential, scalable production, is allied to the West, and is very strategic either to others in the nuclear fuel cycle themselves, or maybe even to sovereign wealth funds outside of that. And for that reason, we still think, despite the rally in the prices, and particularly because uranium is a special case, and despite this rally, still only represents a very small proportion of the cost of producing electricity. At $100, it's maybe 8%, which is a huge contrast to, say, natural gas or oil or any other form of baseload production. You can still withstand higher prices. And I think that's probably something which we are going to see as the continued utility contracting cycle takes place. If you can move forward again, a slide there, please, Rob. The next one is the energy transition. I'd say this is very much a key theme, but there are times to emphasize this. And I'd say at the moment, we are seeing better relative value in the raw fossil fuel energy cycle, as Rob has already outlined. It is still, nevertheless, a theme that we have played. I would just talk to here, say, lithium, which typically garners most of the attention. It has played into the talismanic EV market share growth that we've seen as governments have alighted on that as their sort of push to the public for transition. But what we've seen in the light blue line there is a very significant ramp up in lithium prices as that push took place. But then we had a bit of a crisis, spurred in some senses by demand being sated from the consumer, and a bit of a destocking cycle across the car manufacturing sector overall. That includes the internal combustion engine, but also EVs, at a time when some new project supply was coming on stream, as a result of which the price collapsed. I think, our lithium exposure I wouldn't overplay at the moment, but to give you a flavour for our style of investment, I would note that, we do look at these themes on a medium and longer term perspective. We take the commodity at top down, and then we look at the value of projects from a bottom up perspective. And Rob, as the geologist, picked out an absolute winner in a company called Sigma Lithium, hard rock, one of the highest grades globally. And we started buying that in 2018. We actually largely had sold out of it at the peak of the chart there. But now that we've had the price collapse and the commodity appears to be forming a bit of a base as the Chinese lepidolite production starts to fall away, we're almost being tempted back in if we can see the valuations perhaps see a bit more of a correction. But, we've just acquired a little bit more of the Sigma back. Copper I'll pick up on the next page. I wouldn't labour too much on this one, but we like copper as the base metal of choice because it's technology independent, unlike lithium, which feeds into batteries. I didn't listen to all of the Taseko conference, but you can see the bottom right chart there. It's often one that is rolled out for investors. But we need more supply if we're going to deliver electrons from whatever form they come. And I think this is one of our preferred plays for energy transition that's taking place. We've got some of our favoured plays mentioned at the top there, things like Foran Mining, Ero Copper, which is in Brazil. But right now, the valuations of these aren't necessarily as cheap as we would like them in the context of, as I said, the relative prospects and risk reward on offer in the energy space. I would say that in the short term, we're slightly cautious of the domestic Chinese copper demand, in that some of that, a large portion of it, goes into the property sector. And if we look at the bottom left chart there, I would just say that this is an attempt to show the outlook in trend of completions, which tend to absorb most of the copper, versus new property starts. The orange line is property starts, which fell off a cliff, but it is superposed forward 2 years just to show you the correlation of fit out that tends to follow it. That is the black line there. And copper will follow that fit out line, and we just feel that in the shorter term, perhaps the demand isn't going to be as strong as this consensus opinion seems to be forming, and or have formed in the context that the equities aren't necessarily at the valuation that we would prefer. But it is a classic sector which has suffered from underinvestment for the same reasons that we've seen across the commodities market, and there still has been far too little investment in it. And we'll look at it at some point in time. If you flick forward another page, this is shipping that Rob alluded to. Again, this is perhaps an even better illustration of the lack of investment that has taken place in vessels that transport energy around the world. And this shows the pipeline of new builds for vessels, and it is at an all-time low. And for that reason, with some uncertainty still on propulsion regulations, there is very little new investment going into this. And we've still got, for example, crude growth this year of 1 to 2 million barrels, maybe a touch more. We'll see. At the moment, growth projections are okay. But this is a sector which is benefiting hugely on the day rates and is one of the big dividend income streams that we're seeing in the fund. And for that reason, it represents a pretty healthy exposure. And we've held this for quite some time. The NAVs have benefited because they're now moving towards cash flow multiples, having been more based on NAV, and the NAVs of the ships have gone up because steel prices are still relatively high. And for that reason, I think I won't reiterate it anymore. Still a sector that we like. Pass over to Rob just to provide some conclusion, if that's all right.
Yeah. So a quick summary. So the fund itself, Keith and I are very value focused. We think one of the key things we offer here is what is a fairly fluid and difficult sector for new entrants or retail to invest in. We offer them that kind of expertise to allocate. We also, we know management teams, we know the assets. Many assets going to get recycled, and we know many of the pitfalls to look for. So, we think that's one of the things that we offer is that kind of expertise in assessing how people should seek exposure. We think there's some great underlying themes. Some strong fundamental drivers to those. Yes, performance has sort of plateaued over the last 12 months, having previously been very strong for 2 years. We think that there's a good outlook going forward, given those underlying themes. Counterintuitively, it does play into a number of kind of ESG themes in that it's kind of constraining supply, and there's that energy transition. We do seek to gain exposure to that. And I just reiterate that we don't own any iron ore, we don't own BHP, we don't own Rio. We think shareholders are able to do that themselves. We think, given disclosures, there's limited value add that we can kind of add to that beyond sort of broader macro. Look, we think it offers a good opportunity, and very happy to field some questions if there's any coming through.
Yeah, we prefer that. We like Q&A.
Thank you, Keith. Thank you, Rob. Who wants to take the first one? I'm going to ask you, the fund has been performing particularly well. I mean, 28% up. I mean, this is my sort of rough reckoning since the end of February. That's a pretty scorching performance. What's been driving that within the portfolio? Could you tell us what the star turns are?
Can I start there, Rob? I'd say that one of the contributors has been things like the uranium sector, which had seen the price move up to a 15-year high at 107. Yes, we've had a bit of a consolidation, but that is a position that has grown into that kind of scale, but is one that we're very happy to run as a strategic asset. Gold has been the other one, and I would say that there is a much greater focus now on the significant government spending that has been ploughed into economies, both in the West and in the East, and how that is going to be funded. And I think this has raised a real point of contention that the central bank certainly understands, sticky money that's been acquiring bullion and hoarding it, and I think is one that has started to gain traction in the public's eye. And if you've got 33.5 trillion of US government debt, continued debt ceiling negotiations to increase that, at the rates that we're looking at in the next 5 years, as bonds reset, they're going to be issuing over $1 trillion a year just to pay the interest. And I think that is something which is very easy to capture the imagination. And for that reason, we think the gold price is well set. But the key point is that the equities, despite the move that's contributed to this 28%, still have much further to run. As a form of insurance in portfolios now, we think that is, it would be foolish not to have some of that in. And clearly we're quite large in that sector. I'd pass on to Rob to add any comments.
Look, I think it's been fairly broad brush across the underlying themes that we have. I think Keith touched it on there with some of the macro drivers as well. I think the realization that inflation's a bit stickier does lead people kind of looking for some inflation protection. Commodities are obviously pretty empirically historically have always shown relatively good inflation protection. So I think that's seen some flows into it, but there's also been some expectations just around China being weak that they'll be forced to kind of throw out big bazookas and look to stimulate. So that's also been offering some degrees of support.
Okay, now we've had a question about BHP and Anglo. Can I ask you first of all, do you have money in either BHP or Anglo?
We don't, no. So yeah, as we sort of said earlier, we don't kind of focus on the mega caps because we don't feel we can add the same value, but we're very happy to comment on it.
Terrific. Okay, let me pull up the question. Peter Higgins, he basically, it's a takeover battle. Well, yes, one of the biggest ones in decades, he says, with BHP pursuing Anglo American with a rejected 43 billion takeover bid. Could this battle trigger more consolidation in the mining sector? Is there more to come?
Yeah, well, I think what's firstly interesting there is we've seen very high levels of discipline among miners more broadly. So, similar to energy companies, are focused on dividends and buybacks, and have generally been cautious of M&A. So it's going to be interesting to see some M&A coming through. M&A is actually quite constructive because M&A, rather than new builds, doesn't add any new supply. So, firstly, that's important in that it can kind of keep this theme running and keep supporting commodities. Now, M&A itself, yes, we do anticipate a pickup in M&A. We've seen an underinvestment in exploration and development of greenfield projects, especially by the majors. That's clearly what BHP's focus here is, to try and take Anglo's assets for cheaper than it costs to build. So, especially in the inflationary world we've had, it is often cheaper to buy than build. We've been focused on projects that kind of come a little bit earlier down the pipeline. So you look to the producers on the copper side, generally they're quite expensive. Taseko definitely, our prior presenter is certainly cheaper than many of its peers, but the larger peers are often trading on PEs of kind of 40 times. We can actually buy developers or late stage explorers with fairly tier one assets for less than the money that's gone into drilling them out in the first place. So it just shows that kind of valuation discrepancy. So we do anticipate M&A. We try and focus on it from that angle. Will BHP succeed with Anglo? I guess that's yet to be seen. I think there's some real risks around regulators potentially blocking that. Particularly in South Africa, the South African regulator will clearly be quite cautious around allowing that to pass through.
You think it might fall at the regulatory hurdle?
Look, I don't claim to be any complete expert on it, but there are clearly risks to that and a protracted timeline. I think it's interesting that BHP are making this bid. I think the reality is that there's few quality copper assets out there. They're often in very difficult jurisdictions, difficult local issues sometimes, difficult geology. That's one of the reasons that does make it attractive longer term. Even if we do see some risks in the near term. What
would your advice be if you were holding Anglo shares right at this moment? What would your advice be to a retail investor holding that in their portfolio?
Look, I mean, there's a whole load of uncertainties here, but BHP obviously upped their bid. And Anglo rejected it again. I think that's is quite a bold call. Firstly, BHP so far have only been bidding against themselves, so they didn't have any need to necessarily increase it other than to try and make it a sort of smooth, easier transition through. There is quite a large ownership out of South Africa. They may be cautious, but there is a real risk here that BHP could end up being forced or blocked by regulators or walk away from this. And whether you see a kind of counter bid coming from the likes of a sort of Glencore or Vedanta or Rio is, there's a real kind of question mark around that because they haven't thrown the hat in the ring yet. So, not one I would necessarily want to direct anyone to do anything because I could very easily be wrong by the time I've got off this meeting. So, there are certainly risks to it. And I wouldn't say it's going to be plain sailing.
Fair enough. It's one of those things. I'm required to ask the question, and then you're required to say, maybe I better not answer that one. Now, this is one more answerable for you. Precious metals are you described in your very interesting talk at the lowest multiples. Yet gold, copper, various other commodities, not lithium, but various other commodities that are quite a high. Why that contradiction? Why that contrast? And what does the outlook look like to you? Will those two two sets of valuations meet in the middle?
Look, I mean, we clearly take the view that we think the gold stocks are cheap and there is a real catch up in valuation here. Whether those gaps close, I mean, clearly copper has been a real retail favourite. As they kind of term in the industry, it feels like there's quite lots of tourists in that trade, and that in itself kind of presents some risks on the copper mining side. There's clearly been a lot of flows from big kind of macro generalist funds, some hedge fund positioning, both in physical. We've seen some interesting moves just today in what looks like speculative flows, kind of driving fairly volatile moves in the intraday copper price. So we just suggest there's a bit of it, because if it doesn't feed through, the stocks are already implying a higher copper price than we currently see. So we kind of feel much more comfortable kind of putting money into names that are trading at all-time discounts, and we see potential catch-up trades to that as earnings should start to feed through.
So what are you actually putting your money into? What are the lower valuations that you're actually backing with in the fund?
Well, on specific names or
specific names? Yes, please. It just makes it live. It makes it real for the audience.
Sorry. Yeah, so I probably should have clarified on it, but we're very global in our focus. We don't actually have a lot of UK listed names. So the majority of our names are kind of Canada, US, or Australian listed, just down to the nature of where mining and energy companies are listed. The assets themselves are global, so we have plenty of exposure to across LATAM, North America, Africa, and Australia. Limited amount across Asia, but we do have some specific names. So you look to where we're seeing attractive opportunities. So stuff like Emerald Resources would be one of our largest gold weighting. We think that's very it's a very attractive risk profile. So similar to what Taseko were arguing earlier, we like names that are producers but also have development assets, because we think those development assets are often underappreciated. We also like the fact they're companies that are in control of their own destiny, ultimately, because they have cash flow and production. So we generally prefer producers. We will go into some pre-production, but a heavy discount, and it's not a major component of the portfolio. So Emerald offers that, in that it has a very high margin, strong return producing mine in Cambodia, and they have a development asset in Australia, which is kind of district scale, and that doubly leads to a re-rate, or should lead to a re-rate as and when they bring that into production. Equally, you can get a multiple appreciation above that, because it's a perceived de-risking of the jurisdictional risk. Actually, Cambodia have been very obliging, the government there. So they've been giving them more licenses. They've been very fair with tax. The labor issues that many miners have seen globally that squeeze their margins isn't such an issue, because there's a big, large, readily available workforce in Cambodia. Tax regimes remain stable, and they're very, and it's meaningful to the country. So they're highly motivated to keep these projects operating, and very supportive for further growth going forward. So it's kind of gives a bit of colour of how we perceive regional risk and how we view that.
Okay, final question, Rob and Keith. Let me just jump in. We're kind of out of time, but I'll give you another couple of minutes to do this. What kind of exposure can you give investors in your portfolio that they simply wouldn't be able to get for themselves? Like, I can see that you're global, and you describe it as mid cap, but it's over $1 billion dollars market cap. So, between you, if you could summarize why CQS, Natural Resources Growth and Income.
I think if I just kick off, I would say that the closed-end structure really just allows you to get that the valuation benefit over everything else, because the less liquid investments that structure lends itself to. In terms of UK investors in particular, well, anything that doesn't have a UK list is much more easily accessed via this fund, whether that's just a Canada list, an ASX list, or a Johannesburg list if it were down there. But that I wouldn't labour too much. And but the real benefit is that we just meet so many managements that give you, we've seen lots of assets come through with different management teams, and we know to screen them out. But that's the main benefit. It's the size of the company, and it's the jurisdiction in which it's listed.
Yeah, and I'll add to that. I mean, there are some other benefits as well. So, we do a lot of primary deals, which we get shown that, the average UK investor wouldn't get shown. So that allows you to buy shares. In Canada, quite often with that, you can get kind of free warrants, they call it, particularly in some of the smaller cap names. So, into a stronger cycle, which clearly is something we're kind of anticipating here today, that can really juice up additional upside returns, but also potentially offer a bit more protection. So I think really it's that kind of expertise, understanding of the underlying sectors, and knowing management teams that is probably the real differentiator today.
Okay, terrific. Rob and Keith, that's Keith Watson and Robert Crayford, co-fund managers at CQS Natural Resources Growth and Income. Fantastic. Thank you so much for speaking to us today. It has been absolutely terrific. Thank you.
You're welcome. Thank you.
And sad but true, that's it from us after another great investor evening. Thank you very much indeed to all our speakers for joining us live from around the world, some closer than others, but some of them genuinely far away. Likewise, many thanks to everyone who helped organise tonight's webinar. Thank you. And do look out for all the video content from the event with individual company presentations from WS Blue Whale Growth Fund, Kavango Resources, Taseko Mines, and CQS Natural Resources Growth and Income. We'll also make available a full-length video which includes all our speakers on our YouTube channel. And for more focusIR video content, just Google London South East YouTube channel to find a huge back catalogue of high-quality interviews and webinar presentations across many various different sectors. That's it from us. A huge thanks to you all once again for being such a great audience. We look forward to seeing you again on the 9th of July. Have a great evening. Don't forget to share your thoughts on Kavango Resources, Taseko Mines, and CQS Natural Resources Growth and Income on the London South East bulletin boards. It's always a pleasure to hear and see your comments. Thank you so much.